Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HUBC cybersecurity.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. When you look at this company, it is just a fascinating case study in a corporate turnaround. The entire investment narrative around HUBC cybersecurity has fundamentally shifted. And it really all boils down to this landmark financial restructuring they pulled off in early 2025.
Okay, and this wasn't just some minor adjustment, right?
No, not at all. This wasn't just, routine housekeeping on the balance sheet. It was a genuine inflection point. It converted frankly, a very high-risk situation into a real growth opportunity.
Okay, so let's unpack this. If it's an inflection point, we have to look at the numbers they were able to eliminate.
Right. The most striking financial fact is how they resolved their substantial legacy liabilities.
The old baggage.
Exactly. They had combined claims totaling $16.6 million.
Wow.
And they managed to negotiate that all the way down to just $7.5 million in final settlement obligations.
So they just erased $9.1 million in liabilities. Just like that.
Just like that. That kind of debt removal, it stabilizes the ship instantly.
That is huge. But, the question is how? How do they handle the remaining $7.5 million?
And that's where the story gets really, really interesting. They secured $13.5 million in long-term convertible notes.
Okay.
From a single entity, Claymore Capital. But the staggering term here, the thing you have to focus on, is that these notes carry absolutely zero interest.
Zero.
Zero interest. Over 5 years.
Okay, zero interest over 5 years, especially for a company just coming out of a really stressful period. That sounds almost too good to be true. It begs the question, what's the catch?
Yeah.
Why would a financier do that?
That is the critical question. And the answer is in the conversion mechanics. While the debt itself is interest-free, the investor, Claymore, gets compensated through the option to convert that note into equity later on.
Ah, so they're betting on the turnaround.
They are betting big on the turnaround. They give up the interest payments now in exchange for what could be massive upside through equity gains, once the stock price reflects this new, much healthier balance sheet.
So they're positioning for an accumulation phase after the cleanup.
Precisely. And here's the detail that just makes this deal so unique. Claymore Capital is funding those $7.5 million in settlement payments directly.
Wait, so HUB itself doesn't have to pay anything out of pocket right now?
Zero immediate cash outlay from the company to clear all those legacy obligations.
That's pure balance sheet optimization. It frees up all their operational cash.
Every penny. That money isn't for debt service. It's not for paying old claims. It's now entirely for fueling growth, for R&D, for acquisitions.
And I saw they also got an extension on some other notes.
They did. They secured a 6-month extension on another $11 million in notes, which just pushes any near-term refinancing pressure even further down the road.
So what this whole restructuring signals to the market is that management didn't just execute a survival plan.
No, they simultaneously bought themselves a multi-year runway for growth. They've removed that short-term binary risk, the risk of failure from debt, and replaced it with a focus on long-term strategy. The immediate financial worry is just gone.
Okay, so the foundation is set. It's solid. They have the financial breathing room. But good financing alone doesn't sustain a tech company. We have to pivot to the product. What is their core business moat? How defensible is it?
The moat is their specialization in confidential computing and advanced data fabric technology.
Which is a pretty defensible high-margin niche.
Extremely. And it addresses two massive global trends that are only getting bigger.
Let's quickly define those. First, confidential computing. That's about protecting data while it's actively being used, right, in memory.
Exactly. It's protection at the deepest layer, and it aligns perfectly with the big shift towards zero-trust architectures.
Where you assume threats are already inside the network, not just outside.
Right. And the second tailwind is the post-quantum cryptography era. As computing gets more powerful, the need for next-generation, basically uncrackable encryption becomes it becomes essential.
Yeah.
And they're positioned right there.
And to leverage that tech, they made a major move this year, the Black Swan acquisition.
A huge operational catalyst.
Yeah.
The merger agreement was finalized back in January 2025. And this isn't just a small add-on. This materially expands their addressable market and their revenue base right away.
What's so interesting about what Black Swan brought to the table? Was it just the tech?
It was complementary technology, yes, but almost more importantly, a whole new set of customer relationships.
Mhm.
By merging these platforms, the company can now offer these highly integrated solutions instead of just siloed products.
And that integration is absolutely key
Why?
because it dramatically increases customer switching costs. If a client is now relying on one single integrated platform for both their confidential computing and their data analytics, well, that product becomes a lot stickier.
Yeah.
It's much harder to rip out and replace.
It solidifies their position. We should also, we have to acknowledge the geographic factor.
There is really origin.
Yes, that and their focus on advanced encryption, it aligns perfectly with the global tailwind for data sovereignty solutions.
For our listeners, data sovereignty is basically the idea that data is subject to the laws of the country where it's collected.
And with regulators, especially in the EU and Asia, getting much stricter about this, that regional expertise and cutting-edge protection becomes a massive competitive advantage. It's a unique selling point.
Precisely. They're riding these huge structural macro trends. But let's shift to the more technical and regulatory signals, because those really confirmed the turnaround story,
And that brings us to the Nasdaq listing confirmation.
which they got in late February 2025. That was arguably the biggest relief event for the stock all year.
It was a removal of a massive downside risk, a binary risk, really.
Right, the delisting concern was just crushing the stock price, and that confirmation immediately restored institutional eligibility. Before that, a lot of large funds simply couldn't touch the stock no matter how good the tech was.
And if you analyze the sequence of management's actions, it paints a very, very clear picture. It looks like a textbook accumulation phase structure.
Lay out that timeline.
Okay, so February 20th, they resolve the liabilities, announce the zero-interest financing.
Step one.
February 28th, they secure the Nasdaq clearance.
Step two.
Then, just a month later, March 27th, they announce a reverse share split.
That reverse split is something that often makes retail investors nervous. So why should we view this specific split as a sign of institutional readiness and not a symptom of past problems?
And that skepticism is valid. Historically, reverse splits can be a last-ditch effort just to stay compliant. But the context here is everything. When you see a company systematically remove the debt first, secure their listing second, meaning they were already compliant before the split,
Okay.
and then adjust their share structure, it signals preparation. It's a strategic move.
So they're optimizing the capital structure for two main goals. First, make it more attractive to institutions, getting away from that penny stock label.
Right. And second, it prepares the company for potential major growth financing or even future M&A, where a streamlined, higher-priced structure gives you more credibility.
It's management signaling that the cleanup is done, and now we're moving to the next level.
And their credibility is high right now. The CEO's commentary has been specific. It's been action-oriented. They set these clear, difficult targets, resolve the debt, secure the listing, and they delivered on both. Flawlessly and quickly. That execution builds a lot of trust.
Absolutely. So they delivered on the capital structure. The market's focus now shifts completely to operations.
Yeah.
What should investors be watching for over the next few months? What's on the catalyst calendar?
The immediate focus is 100% on the Black Swan integration milestones. This is the crucial stage.
So we need updates on synergies. Are they cross-selling? Is customer retention strong?
Exactly. If those synergy goals aren't met, the whole acquisition loses its value proposition.
But the real make-or-break moment, that will be the full-year results for 2025, right?
That is the critical moment. We expect that around February or March of 2026. It's the first time we'll see hard numbers that fully incorporate Black Swan's revenue and expenses.
And that release will set the growth expectations for all of 2026. It's the next big binary event for the stock. It either confirms the high-growth story or it reveals some serious integration headwinds.
And beyond their own announcements, we should look for external validation.
Like analyst coverage.
Analyst coverage initiation, yes. As the financial uncertainty clears, you'd expect specialized cybersecurity analysts to start covering the company. That introduces the story to a much wider institutional audience.
And we shouldn't forget the macro environment here. Enterprise cybersecurity spending tends to pick up in Q1 as companies deploy new budgets.
Right, that's a nice natural tailwind that's perfectly timed to benefit their focus on zero trust solutions as they head into 2026.
Okay, this all sounds highly constructive. A successful financial turnaround, strong market relevance. But we have to talk about the risks. What's the primary threat here?
The primary threat is the Black Swan integration execution risk.
M&A is hard.
M&A is incredibly hard.
Yeah.
Integration failures are common. You worry about technological debt. Are the systems truly compatible? You worry about culture clashes, losing key talent. Integration success is never, ever guaranteed.
That's the major hurdle they have to clear. But are there any mitigating factors?
There are, and they're important. First, management has already signaled a complete executive-level restructuring, which suggests they're being proactive about creating a single unified command structure.
And the second one?
More importantly, that 5-year zero-interest financing. It provides an extremely long runway. They don't have debt pressure demanding immediate results. They have the luxury of time to methodically prove out those synergies.
That time is invaluable.
Yeah.
Okay, what about the secondary risk? Geopolitical.
The geopolitical concentration risk, yes. Being Israeli headquartered means they are always exposed to regional conflict. That could theoretically affect operations or talent.
But that has to be priced in by now, doesn't it?
I think it is. The key data point here is that Nasdaq confirmation back in February. If regulators and institutional investors saw this as an unmanageable existential risk, they would not have granted that relisting. The fact they cleared that checkpoint suggests the risk is seen as manageable.
One other risk, tying back to the financing deal, dilution. Those convertible notes mean future shareholders will be diluted if the turnaround is successful.
That's an excellent point. It's not free money. It's an exchange of future equity for present-day stability. You have to weigh the cost of survival against the cost of dilution. And in this case, removing $9 million in crippling debt. That clearly outweighed the future dilution risk. They saved the company.
So let's bring it all together. What is the final investment thesis here?
The core thesis is, I think, very straightforward. HUG Cybersecurity has flawlessly executed its financial transformation. They removed the binary downside, risks delisting, and legacy debt. That messy phase is over. Now, the focus shifts entirely to operational execution, proving that the Black Swan synergies can generate accelerating high-margin revenue. They've built the clean, well-funded car. Now they have to actually win the race.
And for someone listening, what kind of time horizon is this thesis built for? This isn't a quick trade.
Absolutely not. This is a classic turnaround story. It's best suited for investors with a 12 to 18-month or even longer horizon.
You're focused on the 2026 growth picture.
Entirely, which will become much clearer after those first full-year results next spring. You have to be willing to tolerate the integration risk in exchange for the potential high returns if, and it's a big if, management executes on those synergies. The company has essentially converted short-term survival concerns into a multi-year runway for growth. The question for investors is whether their unique technology moat can now translate that financial breathing room into accelerating revenue. Keep a close watch on the first full-year results incorporating the acquisition.
That's it for our talk today. If you enjoyed this analysis, make sure you subscribe so you don't miss our next stock analysis.